Inventory valuation. Inventory valuation. When drawing up the statement of financial position, we need to show the correct, most accurate method of calculation. Inventory valuation. When drawing up the statement of financial position, it's important to show inventory at the correct value. You want to try to choose the most realistic method that reflects the actual stock movement. Now, you might say, but why do we even have to value the inventory? Surely we won't know what it cost. Yes, you've got invoices for all the inventory that came in. But assuming that they came in at different prices, you don't necessarily know which ones were sold unless you actually marked each individual item. For some products, that's possible, like if you're a car dealership, but a lot of businesses are not able to do that. And in that case, you need to make your best estimate of what is the actual cost of the stock that is on hand. IFRS requires fair presentation, and this is why we need to make sure that it is as accurate as possible. We also need to make sure that we use the same valuation policy each year, either FIFO or weighted average, which we will look at shortly, because remember that the financial statement figures should be comparable to previous years. Now, if you change your policy, it means you can't actually compare because they would have been drawn up using different bases. As a result, we need to keep the same policy year after year. And if you decide to change the policy because maybe you realize it's not actually reflecting the actual stock movement, then what you would need to do is go and recalculate for previous years and restate those figures. So, moral of the story, get it right the first time. If you're a manufacturer, you would need to do inventory valuation for all your inventory. And remember, a manufacturer has got a number of different types. There's raw materials, there's work in progress, and there's finished goods. And you would need to value all of these. They do not all need to be valued in the same way. You can use different valuation methods for each of them, but you've got to use the same valuation method for the same class of asset. Once you've worked out what you think the actual cost was, most probably, you then need to also consider how much could you actually sell this item for? And then you're going to report in the financial statement at the lower of the cost, which is either FIFO or weighted average, depending on which valuation method you used, compared to the net realizable value. In other words, what you can sell it for, less any costs that you would need to incur to sell it. The lower amount is the amount that you would actually use. So let's have a look at first in, first out. This is exactly what the name implies. This is assuming that whatever is first bought is sold first. We often use it for perishable goods, but it can also be for any other products where the actual stock movement follows this. What you will do is look at all the figures of the items that were bought. They'll usually give you a table showing what you bought in January, February, March, for example, how many items at what price, and so on. When you're calculating the value of your stock on hand, obviously you need to know how many units you've got on hand. So you'd work that out first, and then all you do is you give those items a value from the bottom up. In other words, you assume that your closing stock must have been made up of the last items bought. So all of the last ones up until the amount that is closing stock can be valued at the last price. If the closing stock is more than the quantity bought last, you would use all of that, but then you would also go up to what was bought forth and take the remaining products that need to be valued from that set. And so you would continue up until you valued all of your closing stock. To calculate cost of sales, you can, of course, use the usual opening stock plus purchases minus closing stock, because by now you've calculated closing stock. But if you've got a table like this, it's sometimes easier to simply use exactly the same method as for closing stock, except instead of going bottom up, you go top down. Because if you know how many items were sold, you simply value each of them, starting with the first, then the second, then the third, etc. Simple. To calculate the weighted average, remember I mentioned previously, it's the same formula as when you're calculating the average share price. It is your value over your quantity. So in this case, you're going to use your opening stock plus your purchases over the number of units you had at the beginning plus your units purchased. Keep in mind that obviously if you had any returns, that would be subtracted. So when I say purchases here, I do mean net purchases. And sometimes it's quite useful if they give you information about purchases, go and change the figures on this table over here. So if, for example, there was a return from what you bought forth, go and cross out the amount of the forth and write in a new value for it. Then it makes it a lot easier to work with. Over here, you would simply subtract the returns from the purchases so that you can then calculate the correct amount. Keep in mind that you would also add carriage into here as well. So any delivery costs, just like you would normally have added them into your trading stock or into your cost of sales calculation, you will also include carriage in your average price. If you're using the perpetual inventory system, it gets a little bit interesting, because every time that you sell items, you will have to show the value of the items going out. And so after that, your opening inventory will be a new amount, and you will recalculate your weighted average every single time that you make a new purchase so that your cost of sales is more accurate. If you are using the periodic inventory method, it's a lot easier because you only do the calculation at the year end to value the stock on hand. As usual, periodic is easier. What you just need to remember is that once you've calculated your weighted average price, that is only for 1 unit. Don't show that as your closing stock value. Obviously, your closing stock value is that 1 unit times the number of units on hand at the end. It is also possible to use other valuation methods. Specific identification is the one that is actually the most accurate. Remember I said if you had to actually go and write a little note on each item of what it cost, or if you know a car's license plate and you can make a note, this license plate cost that much, then you can use specific identification. But if you can't track it individually, then there's no way that you can do it. The last method is last in, first out. Now, this one makes the assumption that whatever you bought last is the first one that you sell. Hopefully, you can see that this is not very realistic, usually. There are very few businesses that would operate on that premise. And in fact, if you've got a situation of inflation, like in most countries, you would actually find that your closing inventory value is going to be lower, and therefore your profits would end up being lower, and therefore your taxes would be lower. So of course, SARS says you cannot do this one. So LIFO is not allowed to be used in South Africa for SARS. In addition, the International Financial Reporting Standards don't like it either, because it's not realistic and therefore goes against fair presentation.